Hello and welcome to House Lux Estate, your go-to channel for insightful economic discussions. Here at House Lux Estate, we dive deep into the complexities of the economy to bring you thought-provoking content. Today, we're shifting the lens to explore a topic that typically garners a negative spotlight: inflation. While often viewed unfavorably, inflation does have its perks, and that's precisely what we'll delve into. Stay tuned as we uncover some surprising advantages of inflation. Before diving into the benefits, let's clarify what inflation actually means. Inflation is essentially the rate at which the general level of prices for goods and services rises over time. As prices increase, the purchasing power of currency falls. This means that each dollar you hold buys less than it did in previous times. There are several key drivers behind inflation. One common cause is demand-pull inflation, which occurs when demand for goods and services exceeds supply, pushing prices up. Another is cost-push inflation, where the costs of production inputs, like wages and raw materials, increase, leading producers to raise prices to maintain their profit margins. Additionally, there's what's known as built-in inflation, which is driven by the expectation that prices will continue to rise. This expectation can lead to higher wage demands as employees seek compensation that keeps pace with rising costs, which in turn can lead to further price increases. Now that we have a grasp on what inflation is, let's explore how it can actually be beneficial. First on our list of benefits, inflation can act as a powerful incentive to invest. This might initially seem counterintuitive, given the often negative connotations associated with rising prices. However, it's this very scenario of increasing prices that can make holding cash less appealing. Money sitting in a bank account loses buying power as inflation climbs, which nudges both individuals and businesses to seek alternative avenues for their capital. Consider the implications for investors. With inflation, the value of currency diminishes over time. This propels investors to put their money into assets that are not only resistant to inflation, but can potentially appreciate in value. Real estate, for example, often appreciates in value over time, providing not just a hedge against inflation, but also the potential for lucrative returns. Similarly, stocks represent shares in companies, many of which have the ability to raise prices and thereby maintain or increase their revenues during inflationary periods. Moreover, commodities like gold and oil have historically been favored during high inflation. These resources are globally traded and can often increase in value when currencies weaken. Investing in such commodities can provide a buffer as the purchasing power of money wanes. This strategic shift in investment doesn't just preserve capital, it can actively grow it. By moving money from depreciating cash into appreciating assets, investors and businesses can not only safeguard their wealth, but also expand it. This dynamic underscores a critical aspect of economic behavior during inflationary periods. Investing wisely during times of inflation can lead to substantial gains. Another unexpected benefit of inflation involves debt management. Let's delve into how inflation can subtly ease the financial pressures of debt, particularly through the lens of long-term borrowing. Imagine you've taken out a mortgage or a student loan with a fixed interest rate. Initially, the monthly payments might seem daunting. However, as inflation rises, the real value of the money you owe diminishes. This happens because the purchasing power of money decreases over time when prices increase. To put it simply, if the rate of inflation is at 5% annually, the money you pay back each year is effectively worth 5% less than the year before. This means each dollar you pay back buys less than it did when you originally borrowed it. For borrowers, this translates into paying back their debts with money that's worth less than the money they borrowed, easing the real burden of their debt. Consider someone with a 30-year fixed-rate mortgage. If inflation averages 3% per year, the real cost of their mortgage payments decreases significantly over the decades. This reduction isn't just on paper, it's a tangible relief in their financial obligations, allowing them more flexibility with their income for other expenses or investments. This phenomenon is particularly advantageous for those who have locked in low interest rates on their loans before a period of rising inflation. They end up repaying their debts with devalued dollars, making their initial borrowing terms even more favorable in hindsight. So, in a way, inflation can ease the burden for borrowers over time. Inflation can also stimulate production and employment. When we explore the dynamics of economics, inflation often carries a negative connotation. However, it's fascinating how a moderate level of inflation can actually propel economic activity forward. By influencing both consumer and business behaviors, inflation can play a pivotal role in boosting production and creating jobs. Imagine a scenario where consumers anticipate that prices will climb in the near future. This expectation can lead to an increase in consumption today, as people prefer to buy goods now rather than pay more later. Businesses observing this trend might ramp up production to meet the heightened demand. This increase in production necessitates more labor, thus creating more employment opportunities. On the business side, when companies expect that the prices for their products will rise, they are likely to invest more in production capabilities. This investment doesn't just mean purchasing more materials or goods, it often involves expanding facilities and hiring more staff. Historical examples underscore this phenomenon. Take, for instance, periods of mild inflation in the United States during the post-war booms. These were times when the economy not only grew, but did so robustly. The mild inflation created an environment where businesses were encouraged to expand operations and hire, which in turn reduced unemployment and stimulated further economic growth. Moreover, increased employment leads to a rise in income levels, which then feeds back into the economy as consumers have more to spend. It's a cyclical benefit that can help in maintaining the equilibrium in economic growth. It seems that a little inflation can indeed keep the economic engines running smoothly. Inflation facilitates necessary adjustments in the market. Let's delve into a fascinating aspect of inflation, its role in adjusting relative prices and wages. Now, prices and wages can often be sticky or resistant to downward movement due to various economic and psychological factors. This stickiness can slow down the necessary adjustments that help an economy stay flexible and efficient. Imagine a scenario where a certain industry is no longer as profitable or necessary as it once was, perhaps due to technological advancements or changes in consumer preferences. Normally, we would expect the prices of goods and services in this industry to decrease, reflecting their reduced value. However, due to price stickiness, these adjustments don't always happen swiftly or smoothly. Enter inflation. By generally raising the price level, inflation can help overcome this stickiness. While it might seem paradoxical, inflation allows relative prices to adjust more easily. For instance, if overall prices are rising due to inflation, but the prices in our less profitable industry are stagnant, effectively, these prices are decreasing relative to others. This subtle shift can redirect resources, including labor and capital, towards more vibrant and profitable sectors of the economy. Similarly, wages in different sectors can adjust without the need for nominal cuts, which are often unpalatable both to employees and employers. Inflation makes it possible for real wages to adjust passively, helping the labor market reach equilibrium more smoothly and quickly. Through these adjustments, inflation can contribute to a more dynamic economy. As we wrap up, let's summarize the unexpected benefits of inflation we've discussed today. Inflation, a term that often carries a negative connotation, surprisingly holds several advantageous aspects that can foster economic growth and stability. One of the primary benefits we explored is the incentive to invest. When prices are expected to rise, holding cash becomes less appealing. This scenario pushes both individuals and businesses to invest in assets that will potentially yield higher returns, stimulating economic activity and growth. Another significant advantage is the reduction in the real value of debt. Inflation diminishes the real burden of debt over time, which can be particularly relieving for those with long-term loans, such as mortgages. This essentially means borrowers can pay back their debts with money that's worth less than when they originally borrowed it, easing financial stress and potentially increasing consumer spending. We also touched on how inflation can boost production and employment. As companies predict higher prices, they increase production to maximize profits, which in turn leads to more jobs and potentially higher wages. This cycle can contribute to a more robust and dynamic economy. Finally, inflation aids in the adjustment of relative prices and wages, helping the economy to correct disparities and inefficiencies. This adjustment process ensures resources are allocated more effectively, aligning more closely with current market conditions and demands. Understanding these facets helps us appreciate the complex role inflation plays in our economy. While it's often viewed under a negative light, recognizing its potential benefits is essential for a balanced economic perspective. Thank you for watching this episode on House Lux Estate. If you found this video enlightening, Please don't forget to subscribe for more insightful content. Until next time.